A Sunday night work email can shift your week entirely, making Monday feel predetermined before it even begins. Health, family, and personal downtime often take a back seat when work demands more of your time. This pressure intensifies when costs rise and savings dwindle, leaving little room for genuine choices. Regular debt payments and fixed expenses create a web of obligations that tie your income directly to your job. Over time, stress mounts, energy wanes, and your personal aspirations get delayed for years rather than months. The real cost lies in losing the ability to reject poor work terms, unhealthy spending behaviours, and unfavourable trade-offs. Imagine two households with similar incomes. One builds financial reserves while the other relies on credit to bridge gaps. The first household can pause, negotiate, or pivot, while the second is forced to keep running to avoid falling behind. In this video, we'll delve into actionable rules, the power of savings, the basics of index investing, and how to stay composed during market fluctuations. This video draws inspiration from The Simple Path to Wealth by J.L. Collins, so be sure to subscribe for more practical insights. Wealth becomes achievable when spending is consistently less than income, allowing the surplus to be invested over many years. Debt is essentially borrowed money with mandatory interest payments that drain resources, as it locks in future income. When you add interest charges to everyday purchases, your hard work can end up benefiting lenders rather than building your investments. Even individuals with high incomes can experience fragility if loans and credit cards consume cash flow that could otherwise create reserves. A common pitfall is viewing minimum payments on credit cards as a viable plan instead of a red flag that indicates deeper issues. Paying only the minimums can keep debts lingering for years, while paying in full eliminates ongoing interest payments altogether. This approach works because every dollar that isn't spent or owed can be redirected into assets that grow over time. Eliminating consumer debt also decreases your necessary monthly income, reducing what you need for long-term financial freedom. Start by listing all recurring bills and then prioritize payments to eliminate those with the highest interest rates first. Another effective strategy is to swap reliance on credit with proactive saving, so unexpected situations don't prompt new borrowing. Real option power stems from nurturing a substantial reserve, not from trying to predict market movements or landing the perfect job. FU Money represents a pool of investments and cash that empowers you to reject unfair conditions without panicking. This principle centers on maintaining a high savings rate because saving more accelerates your journey toward financial independence. Lowering expenses also decreases the portfolio size required for future living, as your eventual living costs determine your target. Two individuals can earn the same salary, but the one saving a higher percentage reaches their goal sooner. The other might receive raises, but rising living costs continually push their finish line farther away each year. This concept links daily spending decisions to long-term freedom, since every expense has the power to either confine or liberate your time. Additionally, building a strong reserve lessens anxiety, as it allows you to navigate setbacks without resorting to desperate, short-term decisions. Start by establishing a baseline lifestyle, then seamlessly direct any increases in income into savings automatically. It's essential to view your savings reserve as a safeguard for health, relationships, and purposeful living, not just as a retirement fund. Index investing involves purchasing a fund that encompasses a wide array of companies, allowing your results to mirror the overall market performance. This approach relies on diversification and low costs, since minimizing fees maximizes your investment returns over time. Attempting to select winning stocks increases risk without any guaranteed rewards, and it leads to constant second-guessing of your choices. Broad index funds minimize decision-making, making it easier to remain invested through various market cycles. Costs are critical because fees compound against you, diminishing growth just as interest can enhance it. Opting for low-cost funds enables you to retain a larger portion of your annual returns, and that difference can grow substantially over decades. A straightforward investment strategy includes a total stock index fund for growth paired with a bond fund to limit volatility. Adjusting this mix can reflect your investment timeline and personal comfort levels, avoiding the need to turn investing into a full-time hobby. A smart move is to set up automatic contributions and disregard daily market fluctuations once your plan is established. If this clear investment framework resonates with you, Consider subscribing to enhance your financial strategy step by step. Stock markets can be quite volatile, and significant drops may occur even when the long-term trend is upward. The real risk lies in reacting emotionally, as selling during a downturn transforms a temporary setback into a permanent loss. Market timing tries to sell before declines and buy before recoveries, but it requires consistent, flawless predictions. Most attempts to time the market fail because news is often delayed, emotions cloud judgment, and key turning points are unclear in real time. Think of an investor who sells in a panic and then waits for certainty that never arrives. By the time it feels safe to buy again, prices may have already risen, resulting in a diminished portfolio. This strategy thrives on consistent contributions, occasional rebalancing, and a focus on long-term goals. Remember, volatility is the cost of pursuing higher expected returns as opposed to cash. A valuable habit is establishing clear rules for rebalancing your portfolio and adhering to them without constantly monitoring headlines. Stay focused on your strategy rather than predictions, so that short-term anxieties do not dictate your decisions. To convert investments into income, implement a withdrawal rule that safeguards your portfolio during downturns. A 4% withdrawal rate means taking approximately 4% each year, adjusting thoughtfully as conditions shift. The core principle is to spend less than what your investments grow over time, allowing the balance to recover following downturns. Sequence risk is significant because substantial losses early on can threaten the longevity of your withdrawals during recovery periods. A bond allocation combined with a cash buffer can alleviate the need for forced selling, as you can draw from steadier assets. While this strategy doesn't eliminate risk, it makes adhering to your plan more practical during stressful times. Flexibility is crucial because decreasing withdrawals after a market drop can enhance long-term results. It's essential to plan for taxes and medical expenses, ensuring withdrawals reflect actual cost rather than mere estimates. A tangible step forward is setting an annual spending target and establishing a rule for adjustments during down years. It's also important to review this plan each year, allowing us to focus on living fully instead of obsessing over market fluctuations. The aim isn't endless discussions about wealth, but rather creating a life where work is optional and time is cherished. A straightforward system proves effective by minimizing decisions, alleviating anxiety, and maintaining progress during turbulent times. Living below your means, steering clear of debt, and saving a significant portion of your income generate the foundation for financial freedom. Utilizing low-cost index funds, maintaining a balanced portfolio of stocks and bonds, and adopting a calm approach helps that foundation grow. As your financial reserves increase, stress often diminishes, shifting focus from immediate bills to long-term values. The overarching benefits lead to improved health habits, deeper relationships, and more opportunities for fulfilling projects. Begin with a simple action that boosts savings this month. Even a small increment can lead to substantial growth. After that, automate your contributions, eliminate high-interest debts, and select a straightforward portfolio that you can easily manage. Over the years, staying consistent often outperforms clever strategies because a solid plan remains intact when emotions run high. If you seek more structured frameworks like these, consider subscribing and continue creating your own enduring path.